If you're looking to buy Faraday Future stock, FFIE, then please keep watching this video as we're going to look at the company's recent news, the market's reaction to its performance, and what are the technicals telling us. And more importantly, what would be the best approach to trade this stock given the current market circumstances. As the market remains very volatile, we should always be careful about which stocks we choose, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Over the past few days, Faraday Future managed to stay above the $1 mark for the time being, in an overall price trend where the market seems to have abandoned the company at all. Indeed, right until September 2023, we could have still seen more price fluctuations in the share price, where it seems like, this has completely stopped ever since October. The production of cars has been slow, and the deadlines have been pushed back repeatedly. It's really important to remind ourselves that Faraday Future is a company that lives by surfing off the industry, like the industry's own clout, and the market tendencies towards it. It would be really hard to have an actual narrative that supports the company specifically, especially considering how low the company has fallen and how long and tortuous the road ahead of it seems to be. We may have an argument if the company were producing anything other than promises to its shareholders over the past few years, but so far things have been pretty much, lackluster, and the company has been a meme in the ecosystem. The capital poured in as long as they thought that they would be like having a technical recovery, but no significant effort from the company has been seen in actually developing the products themselves. While there is little to no hope in seeing the short-term catalysts showing up, I think that Faraday Future remains one of the more volatile companies, or companies that may be volatile. With that being said, let's take a look at the technicals. The trading volume of Faraday Future has recently been around 2.1 million shares versus an average volume of 5.8 million shares. Over the past 52 weeks period, the price fluctuated between $1.01 and $105.60. The volume of shares traded tells us how many shares are being bought and sold at any point in time, and if there's enough liquidity to support a trading strategy. If the float is thin, it would be very easy to influence the stock price, but low liquidity could mean that the demand is limited too. When we compare the current volume against the average volume, there might be the possibility for trend reversal or breakthrough if the difference is very large. For instance, if the stock were to break through, the current volume would be significantly higher than the average volume. The market cap of Faraday Future is currently at $20 million versus the enterprise value of $363 million. As we compare the current price to the historical price fluctuations, the stock is 5% higher than the 1-month low, 5% higher than the 3-month low, and 5% higher than the 52 weeks low. On the options market, which often gives a hint on the market sentiment on where the stock price is likely going to head next, the implied volatility is 131%, compared to a historical volatility of 243%. The put-call volume ratio is currently at 109%. It is normal for most stocks to also tend to have a higher put option volume than what they deserve because many institutional investors hedge the long positions by buying put options. The most recent volume of options traded is 408 contracts a day versus the 30-day average of 3.8 thousand. In terms of open interest, the most recent volume of open interest is 285,000 contracts versus the 30-day average of 285,000 contracts. In terms of the shareholder structure, institutional shareholders own 372% of the outstanding shares. The biggest shareholders include BlackRock, Vanguard, and State Street. It's always good to see some institutional participation when holding a stock long term, because it offers a layer of stability and a token of reliability in the medium to long term. It means that the market is confident that it will deliver value in the long term, which is an important factor to consider for the investors. I personally consider the minimum threshold to be around 25 to 30% for institutional ownership, although there are many exceptions to this rule, as there will always be great companies mostly owned by retail traders. The current short interest is 41% of the total float, and 53% of the transactions coming out of the dark pools. Usually, if the short interest is above 15% of the total volume, and a significant portion of it comes out from the dark pools, it may suggest that there could be some institutional positions taken to short the stock. And in this case, I think it's actually right. I do believe that there is a concerted operation going on as far as Faraday Future is concerned. There might be a case made to say that there could be a short squeeze. So right now, the global markets are facing a complex interplay of factors that have the potential to significantly influence the equities worldwide. In this speculative analysis, I believe that the consequences of the global inflation, surging commodity prices, and decline quantitative easing, as well as the rise of inflation rates or interest rates, plus the geopolitical instabilities, are going to play a significant part. The increasing inflation rate has been putting pressures across the globe, threatening the purchasing power, raising the input costs, and impacting corporate profitability. Companies operating internationally may face challenges in managing rising production costs and also to sustain profit margins. Those dynamics could trigger market volatility as investors adjust their risk-return expectations. The upward trajectory of commodity prices, including energy, metals, agricultural products, have been having far-reaching implications for various sectors of the global equities market. The companies heavily dependent on these commodities may experience squeezed profit margins, potentially affecting stock valuations and investor sentiment. The reduction or the end of QE's quantitative easing measures by the central banks worldwide may have resulted in reduced market liquidity. So this in turn could lead to higher borrowing costs for companies seeking capital, which may also discourage investment activities or will. The elevated market volatility plus the reduced investors' appetite may also continue to occur. Now, the central banks around the world are tackling this delicate situation of balancing the inflation rates with the economic stability and, if possible, growth. Central banks opted for aggressive interest rate hikes to combat inflations. Borrowing costs for companies have been rising, which has also slowed down business activities and also fueling the market's volatility in terms of the equity prices. Now, ongoing geopolitical tensions, including trade disputes, political uncertainties, and social unrests, will inject an additional element of volatility into the global markets. Investors may adopt a cautious approach, shifting towards safer assets, impacting the equities. Additionally, the escalating conflicts may disrupt supply chains, negatively impacting the performance of international companies. Given the interconnectedness of global markets, the aforementioned factors have reverberating effects on the US equities market. Companies with significant exposure to international market may face a lot of headwinds resulting from the economic slowdowns, disrupting the supply chains and the currency fluctuations. But nevertheless, the US market is known for its resilience, and the diverse sectors may attract investors seeking safe havens. So really, the current landscape is characterized by global inflation, surging commodity prices, reduced quantitative easing, rising central bank inflation rates, geopolitical instabilities, and also ongoing lack of certainty regarding growth. While the US market may exhibit relative strength due to the safe haven status, it's going to remain interconnected with the global economic landscape. For long-term investors, these conditions may offer opportunities to identify undervalued companies with strong fundamentals and international diversification. With that being said, short-term trades should be approached with caution because of the increased volatility and uncertainty. Overall, my recommendation for Faraday Future FFIE is to stay on the side at least for the time being, and to engage with the stock only if your risk profile is very high, and to buy its shares once things begin showing more resilience and support, and then to enter into the stock with a small and controlled exposure for the short-term holding and trading. I would recommend to commit between 0.5 and 1% of your capital and to split the allocation in batches of 20% at a time over the next 3 to 6 months, so that you may purchase more in case it retraces a lot more.